Thank you for joining me. Let me just make a short introduction. So we were talking about Eurobonds for, if I'm not mistaken, for the last 10 years, but they came as a big topic during the COVID period. So EU Next Generation is the mechanism, 750 billion euros that were introduced by the European Union. So let's start with you, Mr. Vidaković. Let me just. So many are opposing this mechanism, but can you tell us how do you think that financial markets will react to this mechanism?
Yeah. To a large extent, financial markets are already starting to understand what this whole plan is, because it took me almost 6 months to figure out what it is. It's not about fighting against COVID. It's not about green economy. It's not about any of those things that they're nominally stated. It is basically what the football players would call a Hail Mary in order to save and fiscally stabilize Europe. Because if you look at the way everything is structured, it works like this. The rich countries are going to give money to the poor countries. And then the poor countries are going to do some kind of, infrastructure, investments, green IT, and that will make them more resilient. Obviously, it won't. So, and plus, nobody gives anyone anything for free. So here's the game plan. Croatia, for example, gets money, but a significant portion of that money will be returned to the large countries, because the big infrastructural undertakings are not going to be done by Croatian firms. They're going to be done by international firms. So a portion of that money goes out. Now, why is this so important? It's important because of two things. One, all those investments are going to generate value-added tax and revenue for the government. So the fiscal deficit is going to go down. At the same time, it's going to inflate our GDP. So our GDP is going to go up. So once this plan is implemented, it will have an enormous positive effect, but just on paper. All of our bad ratios, debt to GDP, fiscal deficits, they're going to decrease. But if you look for the true effects of that, there will be none. And why do I know that to be true? Because the plan doesn't create any jobs. Croatia is supposed to get $7 billion, euros, and the amount of new jobs created is only going to be 21,000. Now think about it. What's that amount of investment per one job? I mean, I'm sure if Google is developing artificial intelligence, it doesn't cost that much. So this is a redistribution within Europe where the rich are giving to the poor are giving back, but it's artificially improving all the parameters in order to financially stabilize the whole union. And on top of that, the European Union is betting on a really, really significant thing. They're betting that once these Eurobonds are issued, it'll be an American effect, meaning that nobody, just like today, most investors don't look at Kansas bonds or Nebraska bonds. They look at US bonds. That all the investors are going to start looking at European bonds instead of Italian bonds and Greek bonds, which is not going to happen. You will still have national bonds, and those national bonds are still going to be a problem because of national debt. So it's kind of a race against time. Will all the parameters improve? Will all the reforms be undertaken? Will politicians give in to a lot of money and repay debt instead of just using it for political purposes? And it's kind of like a scissor effect. Everything is coming, and pinching you, but will there be enough time and political will to turn this around?
Thank you very much. I think we got a very solid cover to go on from here. Mr. Lucke, Germany is definitely one of the rich countries that is giving money to the poor countries. It was opposing basically introducing of Eurobonds for years. How do you look at that mechanism from German, but also from the broader European perspective?
Well, I don't really think I can comment on all I would like to say regarding your question here, because this is a multifaceted issue. And one issue is more or less the narrow issue that the Corona Recovery Fund is financed by EuroBonds, essentially. Actually, it is not technically a Eurobond, but it is an expenditure of the budget of the European Union, and the budget of the European Union is guaranteed by all the member states. The difference, or perhaps I should first say, because I'm not sure everybody in the audience is familiar with the technicalities of Eurobonds. The specificity of a Eurobond is that on the European level, debt is issued, and each single nation state in the European Union guarantees the whole amount of the debt. Not only its particular share, say proportional to GDP or something like this, but it is liable for the complete amount of debt in the unlikely case that other countries don't service the debt. So one issue is, how unlikely is this case that some countries may not service the debt, may not pay the interest, may not pay the principal in some later period in time. This might happen if there is a sovereign default in the European Union, so if some country is unable or unwilling to follow up on its payments obligations. That is usually an event which is rare, which doesn't occur so often. But it may also occur if some country leaves the European Union. And this is actually the difference between the current Corona Recovery Fund financing and a Eurobond. If we had a Eurobond, then each single country would be liable for the complete debt, even if it leaves the European Union. Leaving the European Union wouldn't make any difference there. But for the Corona Recovery Fund, if a country, say the size of the United Kingdom, decides to leave the European Union, then they say goodbye. And the debt is the debt of the European Union. It's not the debt of Great Britain anymore. Not partially, not completely, nothing. They have just loaded off the debt on the shoulders of the remaining countries. And I think this is something which is dangerous. Because the European Union will not always sail in good weather. There are conflicts hidden mostly between diplomatic phrases, but there are conflicts between European Union countries. There are differences of political objectives, and it may come a time when the European Union is under stress or in severe conditions that one country, or perhaps a couple of countries, think about leaving the European Union. And if this coincides with a huge amount of European debt. I mean, we are just now starting from a level of zero debt, right? So we add some 800 billion euros now, but this is, if you listen to the Commission, just the start of European debt policy. So in 20 years' time, we may not have 800 billion euros debt, but perhaps 8,000 billion euros of debt. And then this huge amount of European debt, which we may possibly pile up in the future, would be an additional incentive for countries to leave the European Union, because then they don't have to service the debt anymore, right? Great solution for Boris Johnson and the likes of him. So this way of financing the Corona Recovery Fund, I think, is a danger to European cohesion, to the cohesion of the European Union. And I leave it with that for the introductory remarks. Actually, many other things I can say about that, but this is something you should be really aware. I think it's a dangerous construction for the coherence of the European Union to finance the Corona Fund like they have done.
Thank you very much, Mr. Tyler. Your general view on the Eurobonds, and do you think that the European Union is generally ready to solve those issues long term, because there is always going to be richer and poorer countries, no matter of cohesion plans, and it is always going to be a certain obstacle whether to go in this direction or not.
Well, the way I see it, the greater problem that we have with the Corona bonds over the Eurobonds is that rather than collectivizing the debt responsibility or debt liability for 19 member states, we're doing it for 27. And as Bernd already said, it creates a greater incentive to pull out of the whole system. Because if a country, for example, Greece, Spain, Italy, some of the southern European countries, were to find that the debt burden became too much, an easy way to shed some of that debt would be to pull out entirely. It's why I find it rather cynical that the European Commission has branded this as the next generation EU project, because in effect, the liability will be passed on to the next generation without any of the real benefits from it. Because some of the most interesting reading over the last 6 months have been the programs that are set out by the member states, setting out what it is that they're planning on spending the money on. The Commission, when they came up with the program, set certain criteria, including, I think it was spending 40% on environmental projects and a certain amount on infrastructure and so on. But if you read the detail in a lot of these national programs that are part of the Next Generation EU strategy, they are very short-term projects. There's no real long-term approaches to infrastructure, no real long-term approaches to institutional changes, and in many ways it's a cementing of bad business practices. We're watching, they've ignored the original Fiscal Responsibility Pact. So whereas in the treaties it says that the debt to GDP ratio should be 60%, as it stands at the moment, the average in the Eurozone is 100%. With even Germany on 70% and Italy on 160%. So we're seeing a sort of normalization of bad practice as a result of this.
Thank you very much. You were saying about the short-term projects. Basically, the whole mechanism is only lasting 3 years, so we'll come later to that. Mr. Vidaković, do you see this mechanism as an attempt to creating EU fiscal policy, and what do we gain from that?
Yes. Basically, yes, absolutely. I will now show you what these two gentlemen have told you on a transactional level. So just give me a split second. And this is the reason why you absolutely need to have a joint fiscal policy. During lunch, we had discussion, and it's exactly the same thing. We're going to look at this. You don't need to step up, it'll be short. We had discussion how Soros broke the Bank of England. In order to break anything, you need to have two things. One, you need to have economic instability, and two, you need to have a policy commitment you cannot maintain. This is the interest rate on a 10-year German bond over last year. So if you look at from the start of the year, the bonds went up. This was the period, no, the bonds went down. This is the interest rates going up, I'm sorry. The interest rate went up. This was the period where the global hedge funds tested European Central Bank and their commitment to maintaining low interest rates. Then, European Central Bank, specifically Philip Lane, made a crucial mistake. He committed to a policy he cannot maintain. Right around here, Philip Lane said that European Central Bank will maintain the difference between interest rates, meaning that if interest rate in Italy is 1%, in Germany it'll be 0. If interest rate in Italy is 3%, in Germany it'll be 2%. So that differential is going to stay around 1%. Then all the hedge funds moved away from the market, and the interest rate decreased. And they decreased because European Central Bank kept buying the bonds. And now we move to the second graph, which is exactly the same, and this is Italy. This is the Italian bonds. So if you see here, in the last couple of months, each of these lines is a week, the interest rates on Italian bonds are going up. Same on all the European banks, all the European bonds, I'm sorry. So why is this happening? Because number one, as I said, we had a policy commitment which cannot be maintained, because you cannot maintain the interest rate differentials because you have different supply of German bonds, different supply of Italian bonds, different demand of German bonds, different demand of Italian bonds. And two, you have the risk premia. So Italian bonds are always going to, as interest rates go up, they're going to differentiate more than German ones. So all you needed was one really, really big catalyst. And that catalyst came in August when Fed said, we're going to start tapering. So now you have the fundamental catalyst that inflation's going up and that American Central Bank has changed the monetary policy. So all we traders do for the last couple of weeks, we basically push the interest rate up, then you exit the position, you wait for the intervention of the European Central Bank, which happens on a weekly basis, and you rinse and repeat, rinse and repeat. At one point, an inflation situation is going to get worse, and this whole scheme I just mentioned with funding through Europe is not going to work out, and these differentials are going to increase. And the moment the newspapers start to write about that, then all the other players, apart from guys like me and hedge funds, are going to enter the market. And then the market's going to split. And then you're going to have a true, what gentleman mentioned, destabilization of Europe. So whatever they mention to you about the problem of what is a European bond, who's paying for it, what are the structural reforms, the bad things are already happening in the market. And I see this every day as a trader on a transactional level. So it's basically a race against time, which I don't think European Central Bank is going to win. Because as we're going to see on the next panel, Christine Lagarde only buys new clothes and cares about green economy. She doesn't care about stuff like this. And this is the dangerous stuff. Thank you.
Thank you. Mr. Lucke, do you think that this whole thing can end up with where the countries that have a huge debt, that they can decrease that debt? Can this mechanism help them at all?
But I don't really see why countries would decrease their debt just because the European Union increases its debt. I think the mechanics is more that countries try to keep their debt level not rising anymore because they know the debt of the European Union will rise, right? Another question is this sustainable? We have the Fiscal Compact treaty between European Union nations, which actually provides for mechanisms which shall reduce excessive debt levels. This European Compact is not a complete success, but it hasn't been without effect either. So it's mediocre in its effect on debt levels, I would say. But the point is, the Fiscal Compact just covers debt at the national level. It does not cover European debt, right? So suddenly there is an open door for the debt makers in the European Union because they can raise European debt without any limit. There is nothing in the European treaties and there's nothing in the Fiscal Compact which prohibits increasing European debt. Actually, it's not quite true what I'm saying because I'm of the opinion, and we challenge this currently at the German Constitutional Court, that the European Union is disallowed to raise any debt, right? Articles 310, 311 of the Treaty on the Function of the European Union say that the budget of the European Union must be balanced and that all expenditures must be covered by own resources. Now comes the tricky issue, what exactly are own resources? You have said in your introductory statement that European debt somehow matches perhaps debt issued by the federal government in the United States. And nobody cares for the debt of Nebraska. I think there is one really important difference between European debt and debt of the federal government of the United States, and this is coverage. The question is always, how is debt covered? Unlike, say, mortgages, government debt is never covered by physical assets, but it is covered by the ability to tax, right? National governments have the ability to tax, so creditors believe that debt will be serviced because the national government can either tax the people, or sometimes if they have their own central bank, they can also print their own money. That's how the debt is covered. The European Union cannot tax. So the debt on the European Union level is not covered by taxes, unlike the debt on the level of the federal government of the United States of America. It is just covered by the promise of the national government to supply the European Union with enough money to service the debt. But that's a promise. This is not a legal obligation, right? So nobody knows really whether the debt issued now by the European Union is covered by anything which is solid, which implies that the European Union will try to get the competence to tax the European citizens. So this is part of the answer which, to the question which you already raised. Is there a change in fiscal policy? Yes. With the Corona Recovery Fund, there is a change in fiscal policy because by allowing the European Union to issue debt, quite consequentially, member states will have to allow the European Union to tax. Otherwise, they cannot convince markets that that service will be provided for. And this is, of course, very dangerous because the European Union has a severe democratic deficiency, as the European Parliament is not voted for in a representative mode, as we all know. So actually, according to the German constitution, it would be illegal that the European Union taxes its citizens, since it doesn't meet certain democratic standards. And therefore, there's a big issue, a legal issue and an economic issue, whether the debt we raise on the European Union level is currently actually solidly covered.
So many obstacles.
Difficult things.
You've mentioned all three of you have mentioned a certain period of time comparison between EU and United States. Do we always get to the point where basically things in United States can't be comparable to those things that are happening in EU when it comes to the debt, to those mechanisms that are referring to all the countries?
I think if we're going to look at the US model, we have to remember that actually it hasn't always been as it currently is. What people forget is that during the Reconstruction era after the Civil War, the US dollar actually kept most of the southern states that had rejoined the Union in recession for the longest time, because the dollar was in effect backed by strong northern industrial states such as New York, New Jersey, Pennsylvania, places like that, where they needed to keep the dollar at a higher level in order to support the export market of industrial goods from those states, which kept poorer agrarian states in the southern states of America in a worse economic situation. Now, I think that's the comparison that people aren't making enough in the Eurozone, which is that the same thing is happening. That, in effect, the euro, despite the mechanism by which interest rates are set by the ECB, is still pulled upwards by northern industrial states such as Germany and France, the Netherlands and Belgium. And I feel that we need to perhaps look at how they overcame that. And it was ultimately about a restructuring of those southern states. The reason why the southern states of America eventually managed to pull themselves out of recession was because technology advanced in a way that it made it more desirable to do business in the southern states.
Thank you. Mr. Vidaković, you said that in the earlier panels, of course, we were talking about inflation. What is your view? How is this concept going to affect inflationary processes on the broader level?
This will increase inflation. And this is another thing. Inflation is an integral part of this plan. European Union needs to have as high inflation as possible. Because if you look at the Croatia, we have an exceptionally high value-added tax. So as a panelist before me mentioned, the higher the prices are, the more there is government revenues. And if you look at, I personally think that it's fairly reasonable to expect that this year plus next year, Croatian GDP is going to grow by 25%, real growth plus inflation. This will create massive fiscal revenues, which will theoretically allow for the possibility for fiscal consolidation and debt repayment. Now, why won't it create an environment for practically to fiscal consolidation and debt repayment? Because the politicians don't function like that. We all know that Plenković is going to just come up with new privileges and increase all the salaries and buy political favors. And I personally think the same thing is going to happen in Italy. So this plan is a great idea, but it's not going to play out. And this is why you have absolutely zero attempts to tackle inflation. I mean, every single time you listen to Christine Lagarde, she doesn't make sense. First, she said that inflation is transitory. Then inflation goes really up for several months, and she says, well, that's good because now we're averaging. So if you take how low inflation was during the pandemic plus how high inflation is now, we are still on the average. Then when inflation goes to 5 or 6%, she's going to say, well, we're now above average, but that's the type of policy we wanted to have. But all that services is basically to tax people and to collect more fiscal revenues in order to create some kind of fiscal consolidation. Now, will the politicians actually follow through on that? They haven't so far. I don't see a reason why they will from now on.
You mentioned 25% GDP raise.
GDP growth, yeah.
Yeah.
I mean, we're going to have a real growth this year of around 9% and inflation of 4 to 5, so that's 13, 14. And then next year, we're going to have, let's say, 6% growth as it is expected now and a 6% inflation, and there you go. And that's basically another 100 billion kunas of GDP, which means another 40 billion of government revenues. And then Andrej Plenković is going to have a field day.
Not a good thing for consumers if we are going to have inflation of 5 or 6% per year.
Well, how did you think that politicians are going to achieve all this without someone paying the price? Because that thing I showed you over there, I don't care. I'm going to use a Italian reference. I don't care about Luigi and Mario. If Italy breaks down and it creates another 2 million unemployed Italians, that's not my problem. I look to make money by shorting Italian bonds. So if Andrej Plenković is going to become the head of European Commission by making sure all this follows through, while Croatian people standards decreases by 10%, well, someone's got to pay the price. So people should pay the price. That's how this whole European thing works. In case you haven't figured it out by now.
Mr. Lucke, this is a relatively short-term mechanism, but there was also already initiatives that it's not just a short-term that is going to end by 2023. How do you see what's going to happen after that?
Well, I was already tempted to dispute your claim that it's short-term, because when you say short-term, you think of the expenditure side of the program. The revenue side of the program is very much long-term, because the last bonds will be paid for, I think, in 2058. I will be dead by that. So That's a really long debt, which they long-term debt, which they issue there. And I agree with the implicit statement in your question that probably more expenditures will be added and more debt will be added. This Corona fund was just the door opener for European debt, for allowing European debt in a perceived emergency situation, and now we got it. And now the Commission will, on the next opportunity, say, hey, it worked well, why don't we do it again, right? And so it becomes a permanent mechanism. And as I already said, debt must eventually be paid back by means of taxes. But there are two sorts of taxes, and you have rightly reminded the audience that one way of taxing people is not using formal fiscal taxes like value-added tax or income tax or taxes on real estate or whatever, but this what the economists call the inflation tax, right? Inflation also takes away purchasing power from the people because the money we have is less valuable due to inflation. So this is like a formal tax. In its economic effects, it's like a formal tax. And I think the European Central Bank aimed precisely for that when they when they started the quantitative easing policy. They wanted to drive inflation up in order to devalue the debt, the government debt in the Eurozone and perhaps in the European Union as a whole. And this whole thing just didn't work out because inflation didn't go up. To the surprise of most economists, me included, we didn't see this inflation. But the European Central Bank saw, well, it's not all that bad, actually, because we can still stabilize debt without inflation, and that's an important point, by depressing interest rates down to zero. For if interest rates are zero, then you don't need to bother about your debt, right? You don't pay any interest on it, so you can issue as much debt as you want to. Actually, you can show that you can have debt grow faster than GDP without any problems if the interest rate is lower than the growth rate of GDP. So if the interest rate is zero and the economy grows, then everything is fine. Now you have to be aware that zero interest rates is actually also inflationary. It's just the flip side in some sense of in inflation. I will give you two examples of that. One thing is that when interest rates are low, then real estate prices go up. Because obviously mortgages are easy to service, so people are willing to pay much higher prices for interest rates because they hardly have to pay in any interest on their mortgages. And this is what we have seen in the Eurozone, that, and not only in the Eurozone, that real estate prices have gone up. But when real estate prices go up, then rents also go up. And this is what we also see. And there is the inflation, right? For the ordinary people who don't own the real estate, but who rent their flats, they have to pay higher rents, and that's part of the inflation. So does this mean the ordinary people actually pay for the debt? Well, yes, of course, it does mean that. But the rich people also pay for the debt by the following mechanism. Rich people typically save a lot of wealth, and they want to consume at least parts of this wealth when they get old. But obviously, when interest rates are low, then they have less interest income, which means that the future consumption cannot be as easily financed as they would have been able to finance it with higher interest rates. So actually, low interest rates means that the price of consumption in the future is going up. And that's also inflation, but it is not measured by our statisticians as inflation. So you may turn it which way you want to turn it. It always boils down to the issue the government finds non-formal ways of taking purchasing power away from the people, so non-formal ways of taxing the people. And we will have to pay for all this debt one way or the other.
Thank you very much, Mr. Vidaković.
And just to add one more sentence, and in order, just to continue, and in order to increase overall consumption in a country, and to depress wages and decrease wages, you allow a huge amount of foreign immigration, which gives you more people, which means consumption goes up. And because you increase number of people, you basically decrease wages, which maintains company profits. Did I cover the game plan?
So basically, many wrong or bad implications of the interest rates, Mr. Tyler. Where should interest rates go from there?
Well, if I could just comment perhaps on the notion that this is a temporary measure. I mean, there's the great quote by Milton Friedman, which is that there's nothing more permanent than a temporary government response. But I think in terms of talking about the inflation and so on, I think the real risk that we haven't talked about yet is stagflation, which is that productivity in many EU member states hasn't kept up with the rate in which inflation has gone up. And whilst I'm sure there are many in the European Commission and the ECB who think that these corona bonds will be the response to that, if you look at where the money is going to be invested, and it very much is being done in a Keynesian manner, the investment that's supposed to stimulate the economy isn't going into the productive bits of the economy. It's going into very niche technological programs that don't increase productivity. It's not being invested in large construction works. It's not being invested in future-proofing industry or future-proofing services or restructuring the economy. It's being invested in yesterday's technology to try and meet certain arbitrary criteria regarding green technology or various other things. And I think that the risk is that that won't increase the productivity of the country in the same way, and nor will it address the issue of increased unemployment or a lack of people in work.
Okay, thank you. Let me just ask if somebody from the audience have a certain question for panelists. Okay, please.
Thank you. Just to maybe go a little bit deeper into the topic of inflation and inflation in the last 10 years, it was also said earlier that some people believe there has not been high inflation. I personally would disagree. If you look at asset inflation, I mean, this is not measured. Only recently the ECB said they were also going to include housing in inflation measuring. I think most people would instinctively consider this as part of inflation. So my question is, what's your opinion on this? Did we have high inflation in the last 10 years, also including assets like stocks and housing, or do you think it's fair for central banks not to include those assets?
Okay, please.
Well, in this case, I would like to defend the position of the European Central Bank. I think we have not had inflation. Obviously, this depends on how you define inflation. But the usual way of defining inflation is to say this is a rise of the general price level. Basically, all the prices of all the commodities rise by the same amount, which has no real effect or may not have any real effect because sort of the relative prices are unchanged. What you allude to, this what is sometimes labeled asset price inflation, is not inflation in this sense. The rise of asset prices is a change in relative prices, right? Assets become much more expensive than consumer goods, for instance. So economists would say this is a relative price change, but it is not inflation in the sense of a general rise of the price level.
Okay, please.
Just to address the game plan for stagflation. As I said, in theory, the fiscal revenues rise a lot. Governments have too much money. They start paying off their debt. The quantity of debt in the market decreases by too much, and there are no bonds. The only way to get bonds is for the central bank, European Central Bank, basically to start decreasing its balance sheet. So that's the game plan to fight stagflation. Will it happen? I don't know.
Okay. Anyone else? Okay. Mr. Vidaković, do we have to, on the European level, do we have to fear of this stagflation? It seems like a bad case scenario where we don't have a GDP growth and we have a certain level of inflation.
There's nothing to fear except bad politicians. That's it. Give a politician too much money, they're going to spend it around. That's the problem. That's what's going to happen.
If we could just compare for a second this EuroBonds, it was said that they are connected, Mr. Lucke, to a multi-annual financial framework. They were brought basically at this at the same time. Do you think that these two mechanisms are coherent and that they're going in the same direction?
Sorry, it escaped my attention. Which two mechanisms do you mean?
Multi-annual financial framework of the European Union and the Eurobonds.
Well, the multi-annual framework of the European Union is a planning period of 7 years.
Yeah.
The debt we issue now has a planning period of 40 years, approximately, a little less than 40 years. So clearly, it is much longer and it is not covered by any multi-annual financial framework. In that sense, I wouldn't say that the two things are contradictory, but clearly there is not enough planning beyond the current 7-year multi-annual financial framework on how to service the debt. There is this promise by governments, yes, we will cover that, but they have not said with which kind of resources they will cover it. They have not said how coverage will be shared between them. So this is a very vague pledge which they have given, and it is not legally binding as it would be if it were part of a multi-annual financial framework.
Mr. Tyler, seems that all of you agree that those Eurobonds have a conceptual problem, but also something that is connected to the complete functioning of European Union. How do you tackle that in the future?
I think the problem at the core of all this is a matter of trust, as isn't the case with any monetary policy. You need people to have faith in the debtors and so on. And by collectivizing the debt liability in the way that a Eurobond does, it makes the assumption that every one of the 27 member states that has signed up to this can trust the other one not to pull out and leave them high and dry. And I think that is ultimately a very challenging political obstacle to overcome, because the financial crisis of 2007, 2008 and the euro crisis that followed has left a lot of bad blood. You know, many northern European states don't trust the southern European states to control their spending and to control their debt raising levels. We saw this manifested during the negotiation of the MFF, when you had the so-called frugal four countries, which oddly enough excluded Germany. It was Austria, the Netherlands, Denmark, and Sweden, who all ultimately found themselves in a position where they said they couldn't trust the other member states, and they couldn't understand why they had to underwrite the liability for states that haven't gone through a period of economic structural reform necessary to ensure that they are in a position where they could guarantee the debt themselves.
We had, in the last financial crisis, we had basically austerity measures. Now we have a completely different approach. If some countries end up in a situation in which Greece was in the last financial crisis, what would be the best solution made by the European Union?
That is actually a half good question. The better question would be, which country has a problem. Because this is what we saw.
Greece.
Then, austerity is great. Germany has a problem. Then austerity is not great. Because this is what we have saw. In 2012, Greece had a problem, austerity. Today, Germany has a problem, now fiscal expansion is great. This kind of, plus what was mentioned, the lack of trust, is the biggest problem of European Union. European Union is a club of countries that have their particular interests. It is not a union of countries that have faith in each other in order to create something better. And we have already seen that being clearly politically demonstrated where, as I mentioned this morning, a Dutch prime minister says to Hungarian prime minister, just leave, where Poland is being pressured the way it was pressured. So instead of embracing diversity and saying we're all different, but we're all Europeans, it basically comes to a power play. So whoever has the most power, he will dictate the policy. And the policy will be what the power wants. And this is what I'm afraid for us in EU and in Euro, that somebody will force policies on us which will be really, really bad for ordinary people. And you are already facing that, what I said with inflation. But nobody cares. And that's why this referendum is so important. It is not just the referendum. It is actually, will the signatures be collected? Because if the signatures are not collected for the referendum, that means the people have accepted a large possibility of a decrease in standard. And people are willing to sacrifice themselves for politicians. And then you do not have a democracy. You have dictatorship. Then what's the point of all of this if people do not make any choices? So that's what you have asked is the fundamental problem of European Union. And I was like you, but I was even younger. I wrote my first scientific paper when I was 13 years old. And it was on European Union. And it was how great it is, and how great it will and can become. I have no idea what happened in the meantime. Because this is, again, not a union of friends. It's a union of power interests. And that can never lead to a good future. It was already tried in Soviet Union. It didn't work out.
So, the solution to that?
Very simple. Acceptance. Solving problems. Not putting petty interests of your country in front of everyone. Creating an environment where everyone is a European. But politicians don't do that.
Mr. Lucke, we can come back to the start. Different countries, different interests. From at least 10-year perspective, we have a situation where Mediterranean countries want debting that we have at the moment, and 4 or 5 prominent rich countries don't want that. We have a certain solution, but I believe nobody is extremely happy with that.
Yes, there are the differences of interest in the European Union, and I would perhaps phrase it a little different from the way you did, by saying the Mediterranean countries or the weaker countries in Europe are not per se interested in higher debt, but they are interested in the transfers of money they receive. Whether this is financed by debt or by taxes doesn't play a role, but they want to have some kind of redistribution mechanism within Europe, which they say, partially correctly, they need in order to stay in the Eurozone, because they have been disadvantaged by the common currency, and so they need some compensation in terms of fiscal transfers. Okay, so that's an issue we have already commented upon. But another issue is this issue of trust, which was also sort of in your question and previous remarks here. And I would like to comment on this trust issue from another perspective, namely not trust between the member countries or lack of trust, whatever. But another important thing is the trust between the citizens and the governments. Right? This type of, how shall I say, vertical trust rather than horizontal trust between member countries. And here I would like to point out some of the legal problems we have in the European Union. It has already been mentioned, Dutch Prime Minister telling the Hungarians just to leave or something like this. We know the bad guys in the European Union are Poland and Hungary, right? And the bad guy outside the European Union is the United Kingdom. And the issue here is always rule of law. Hungary and Poland are criticized because people say this is not rule of law the way we like it. The United Kingdom is criticized because people say you don't honor our treaties, right? North Ireland Protocol and these kind of things, also rule of law. There are many things to debate about that, and actually I myself are also critical of some of the things which happened in Poland, but I'm also critical of what the European Union is doing with its own law, right? Because the rule of law has been massively damaged in the European Union due to the fact that at least 3 articles of the European treaties have been violated by the European institutions. There was first Article 125, which forbids bailouts, essentially, right? It says no country must step in for other countries' debts. And we know this article has not only been ignored in the Eurozone crisis, but it has been turned on its head in the Eurozone countries. The European Union has done exactly the opposite of what was provided for by the fathers of the treaties. So they have broken European law, and then they point at Poland and Hungary and say, well the rule of law is not good in your countries. Next issue was 2015, when the European Central Bank violated Article 123 of the Treaty on the Functioning of the European Union. Article 123 forbids the monetary financing of governments. But the European Central Bank now buys government bonds against freshly printed money massively and for years, which is very clearly against the whole spirit of Article 123. So the rule of law is not upheld here at European Union level. And now with the Corona funds, and here I will end, Article 310 and 311 of the TFEU is violated again because these articles very clearly say that the European Union must not issue own debt. And we do exactly the opposite again. The European Union breaks the Treaty on the Functioning of the European Union. That's actually a scandal. And hardly anybody pays attention to this fact. But the question is whether the trust of the citizens is not severely damaged if a government, in this case the European Commission, always thinks that the law is just to abide for by other people, but not for itself. It can just turn it on its head, right? This, I think, undermines democracy, undermines the trust in our institutions. And at this point, it becomes not a legal issue anymore. It's actually a political issue. Even if there are clever experts of constitutional law which can find some loopholes in the European treaties which allow it to defend those breaches of the spirit of the treaty, that's not the point. The citizens expect that sort of the obvious wording of the article is being respected. They don't care for any kind of legal high-tech by which you can turn this upside down. They want that exactly that is respected, what in a common man's understanding or common woman's understanding is the meaning of the Treaty on the Functioning of the European Union. And the EU Commission and the EU Council and the member countries are just ignoring that. And that, as I say, I think is a very dangerous issue of trust, of lack of trust between citizens and our democratically elected governments. So it is a crisis of democracy, actually.
Thank you. Mr. Tyler, you were pretty critical of the way that this money will be spent in the EU next generation. Do you think it will reduce the European Union's potential growth in the period that's ahead of us?
Do you mean in terms of the growth of the union itself or the growth in the economy?
Economy.
Economy.
No.
I think that's yet to be seen. I think it's like all Keynesian spending, which is that it might have a short-term benefit, but ultimately you've got a long-term debt liability to repay that will outnumber that. And if you look at a lot of the ways that the member states are going to spend this money, it doesn't match. It doesn't boost the growth of the independent states. I think we should come back to a principle of subsidiarity here, which is we talk about a European economy, but it's not. It's a collection of 27 different economies. So you might see growth in some countries, but in other ones you won't. Mm-hmm. And I think this feeds into the trust thing, the trust issue, which is that in effect we're trying to create trust between the member states over who's going to spend it responsibly. But I think when taxpayers in perhaps the Netherlands see how money is that they have paid, that they've raised through taxes and sent to the European Union, and that have been raised in debt again by the ECB, when they see how that money is being spent in southern European countries, it'll create further resentment. We've seen a sharp rise in Euroscepticism since the financial crisis on that basis, that a lot of northern European member states became critical of the way in which the money that they had used in bailouts was being spent in Greece, for example. It was effectively, as I said earlier, an endorsement of bad business practice. We rather than seeing any real austerity or restructuring, we saw the debt being used and the bailouts being used to carry on with business as usual.
Thank you very much. I think we have enough time for your final remarks. Mr. Vidaković, one of your will probably don't give too much money to politicians.
No, I'm of the world. A trader in me wants things to go really, really bad so I can make money trading. But an economist in me, to a large extent, wants this to succeed. But I have seen especially in Croatia, so many politicians promising so much that at one point you simply lose faith. I mean, don't you think that what three of us are saying, the prime ministers of EU don't get? Of course they get it. And of course they know that inflation is going to go up. And of course they know people are going to pay the price. So I don't know, choose wisely.
Mr. Lucke, your final remarks.
Well, I think I have basically said what is important about this Corona fund. So my final remark is more about the general principle which the European Union employs, that they always think a crisis is the time to breach the treaties, right? To break the treaties and to gain more competences for the European Union. That is dangerous. Actually, the prime concern in a crisis for national governments or for the European Union should be to fight the crisis, not to enlarge one's own power. It is dangerous because people may think, we are overrun here, right in a situation where everybody of us is busy dealing with a crisis, be it a health crisis like Corona, be it a financial crisis where people worry about their financial wealth, there the politicians make use of our preoccupation with other things and do things which are not really democratically legitimate. This, I think, is actually a strategy of European Union leaders to proceed like that. And it would be important that in times in which there is no crisis, political parties rise up and say, hey, we can't do it that way. But this, of course, this requires that the general public is even aware of what is happening. And most of these things are so complicated and require so much knowledge that the ordinary citizen on the streets just doesn't understand what's going on, right? Plus, many media actually don't inform them well, or just repeat what the government has said and applaud the government without understanding themselves what's going on. And here's the final sentence then. For this reason, I think this referendum would be really a huge chance for the critical parties united in the ECR to draw more attention to its political agenda and to its political content. Probably you won't be able to stop the introduction of the euro in Croatia, and perhaps it won't be as bad as it was for Greece, if you're lucky. But politically, I think, if you really manage to get 10% of the Croatian population to sign up for a population, and you can then say, hey, it's us who did it, that would be really great. And I wish you all success that you need to achieve that aim.
Mr. Tyler?
I think for me, summing up would be this, that if we're to return to fiscal responsibility, the answer isn't to go through a Corona bond or a Eurobond. It's to restore a sense of national responsibility. And that means that we need to restore, in order to restore trust between the member states, we need the member states to prove that they can control their own spending, that they can control their debt raising. It should be on the individual states to determine how they capitalize themselves, how they raise funds. It shouldn't be up to the European Union to step in and support them. And I think once you've restored that degree of subsidiarity and that it's the member states who are responsible for their own economies, I think then you finally have the burden of proof that countries can look after their own economies, and then perhaps you can start talking about something on a higher level. But for me, I don't see that as being viable at the moment, and I think, unfortunately, we'll be stuck with the current situation.
Okay, not a very optimistic closure. Thank you very much to my panelists. And now I will announce Mr. Palic's presentation. I believe the technical issues have been solved. So, Mr. Palic, please.